to today's discussion about the best performing stocks over the past 20 years, okay? That is the best performing stocks in the last 20 years. We want to sustain growth and increase our profit margin. And one of the ways that we can do that is investing, okay? One of the ways that we can do that is investing. So hopefully everyone is doing great this evening. Hopefully your job didn't stress you out. Hopefully that any of your clients didn't stress you out if you have your own business. And most importantly of all, hopefully your kids didn't stress you out. Okay? Anyway, let's get right into it. I'm going to go ahead and change my screens so I can share this information with you. Now, I have 4 stocks to go over, and we're going to briefly go over them, guys. I'm going to leave some time for you guys to answer any questions or anything of that nature. So when you guys come in, ask any questions that you may have, especially about the video I released today around noon. My phone didn't notify me, so I'm sorry if you guys was chatting, but I should have been a part of that premiere. Anyway, let's get right into some of the best stocks that has been performing high returns over the past 20 years. We're going right into it. Okay. First up, we have Holy Frontier Corporation. Okay. If you notice, it is a petroleum refining company. Now, a lot of times I tell you guys and girls to invest in ETFs and index funds, but I do also express that you want a well diversified portfolio. And in having so, you have to have some regular stocks within your financial diversified portfolio. And I'm going to give you the best 4 stocks. I did have 5, and one of those 5 was a tobacco company. But if you notice, less and less people are smoking tobacco products. So I'd rather not give you one that's on a steady decline and is not maintaining its current value or increasing in value or even appreciating in value, okay? So again, this is Holy Frontier Corporation. It is a oil company, or AKA petroleum refining company. And it's a Fortune 500 company that's based in Dallas, Texas. And it distributes petroleum products from gasoline to petroleum-based lubricants and waxes, okay? So you can look at the revenue there at $14 billion, number of employees, 3,500, and then total assets is $10 billion. Now right here, this is coming from Google Finance. As you can tell, we're just looking at the graph. Let's do the 5-year mark, even though this is for the past 20 years. So we go all the way back to 2015. $30, right? So $30. And again, out of the 4 stocks, 3 of these are under $100. So take, for instance, Holy Frontier. Back in 2015, it was worth $30.84. Then at its peak here in 2018, look how much it rolls up. Now and again, oil prices fluctuate with how much things are a barrel, what's going on in the Middle East, what's going on in America. Did the president start a war with Iran, et cetera, et cetera, et cetera, right? So that's what it really boils down to. So if you would have bought your stocks or your shares of this stock back in 2015 at $30 and you would have sold it June 1st at 2018, you would have doubled your money. You would have doubled your money, okay? Now, if you notice, it's been ticking here, been slowly ticking down, ticking down. Boom. Now it's worth $48.35. Now, looking at the performance of this stock, I got a little bit of history on here because it owns and operates 5 large refineries in Wyoming, Utah, Kansas, Oklahoma, and New Mexico. And see, it has a significant location advantage over other refineries in the U.S., such as, those on the East Coast and Gulf Coast, because those refineries are close to the location of booming U.S. shale operations. So in the past decade, the advances in hydraulic fracturing technology have increased U.S. oil production and, has increased the amount of oil that the U.S. producing, which has doubled from 2008 to 2018. And that's mainly because Obama, he started fracking and refining that oil for us to use. So we are highly producing our own oil, which is great. Now, there's two major centers of this shale boom. It has been in Bacon Fields in North Dakota and a place in Eagle Ford formations in Texas. So this understanding a company, the way they're structured, can also help you when you are diversifying your portfolio. Would I invest in this? I would. Am I investing in this? I'm not. So just a matter of you doing your deep dive and doing your research. I am just giving you some options to diversify your portfolio, okay? Let me see if I go to Google Finance, see if it takes it back any. Let's see if we can go a little further. All right, it won't let us go back any further than that. That's okay. We're moving right along. Next one up is Old Dominion Freight. Now, this is the one that is, of course, above $100. Okay, it's, of course, above $100. And this is American Truckload Shipping Company or trucking company, right? And it's regional, interregional, and national. Their revenue is $3 billion. And the number of employees is 21,000. This is an old trucking company. Old Dominion, right? So we know there's a trucking company. Its growth hasn't been driven by any special trend or rebranding or remarketing or monster attractive, but it's just been an exceptionally well-ran business. It's essentially increasing operating ratios and margin of expense to sales, showing business efficiencies from just 90% in 2006 to under 80 in 2018. So it's managed to increase its percentage on-time deliveries from 94% in 2002 to 99% in 2018. So it's a well-ran business. A lot of that has to do with management, personnel, etc. Even technology has helped them to raise their deliveries from 94% in 2002 being on time to 99% in 2018. See, the company has a 12.7 annual growth rate in revenue over the past 21 years, expanding their company market share from 2.9 in 2002 to a whopping 10% in 2018. That's pretty darn good. Let's look at the 5-year growth here. All right. So we look back here in 2015, this stock was worth $74.13. And if we take it at its peak right around here, it is worth $192. So these stocks are fluctuating up and down, up and down. Sterling Lee says, don't invest in stocks after the recession. Everything is overbought right now. A correction is due. That is correct, Sterling. But as I will always say, we can't dictate when the market is going to go into a recession or depression. And every day that you're outside the market, you lose money. I mean, could you go ahead and buy 5 of these stocks right now and you pay that $189 price per share, and next day the stock market crashes, the next day we have a recession and this stock goes to $50? Yes, it can. But this is the problem. We can't predict the future, and we are due a market correction as well as a recession at the 10-year mark. See, 2008 was a recession. 2009 is when we started recovering. So 2020 is the year where it should be due, because on average, every 10 years, we have a market correction / a recession. But here's the thing. We do not know. We can go off statistics and analytics and the trend of the history. We can. But every day you stay out the market is a day that you're not going to make money. Now, if you're going to wait around for this recession that nobody knows what's going to happen, then so be it. My thing is, don't wait around. If you got the money, a lot of you about to get your tax returns, go ahead and invest your money. And then over the course of time, especially if you're in your 20s, 30s, or 40s, and even in your 50s, you have time to recuperate that money plus more, because the stock market has been breaking records from the time the recession happened up until now. It continues to break records and it always bounces back. So I don't think you'll be losing any money. Only thing if happens, if it does go into recession this year and you buy it at the discount price, let's just say, for instance, Old Dominion Freight Line goes down to $50 and you buy that, you will make even more money. But again, I'm not Nostradamus. I can't predict the future. I'm going to use my money and I'm not going to invest. All right, that's my piece about that. Moving right along. We're going to move to, you've seen this one before, ladies and gentlemen. Tractor Supply Company. Tractor Supply Company, okay, is an American retail chain of stores that offers products from home improvement, agriculture, lawn and garden, maintenance, and livestock. Now, a lot of you know about this, okay? It's based out of Tennessee, and it has 1,800 locations, right? It's not giving us any math about it, but that's okay. We'll talk a little bit about it. What do we know about good old Tractor Supply? All right. Now, this is a lot of people who farm go into Tractor Supply because it has a lot of the equipment that they need. No, the number of these farms alternatively referred to as Harvey farms, right? Lifestyle farms or residential farms. I know a buddy of mine, he had a house near everybody else, and that's what they call a residential farm, where you're in a residential neighborhood. You're not a commercial farm. And see, because of everyone wants to grow their own food, have their own chickens, etc., Tractor Supply has grown enormously in the past decade. Now, the number of residential farms outside of large cities has doubled from the end of 2008. If you notice, everything is going on that particular time. But it has doubled from the end of 2008 to the end of 2013. As of most recent Department of Agriculture census, 38% of all farms, the largest category, had owners whose primary occupation is other than farming. See, by focusing directly on this market, Tractor Supply has managed to grow despite the continual headwinds against retailers in the past 20 years. And plus, they do home improvement, but on a smaller scale. It's not going to be like your Home Depot or your Lowe's, but it has a plethora of products that you can go in and actually buy if you don't want to go to one of those huge stores. Tractor Supply stores are about medium size when I compare it to maybe a local Home Depot or Lowe's. So that's something you might want to look into investing. Again, we got 3 that are under $100, and we have one where we just went over was Old Dominion, was the trucking company. And this is a retail chain company dealing with agriculture, lawn and garden maintenance, and livestock equipment. Okay. And last but not least, we have Monster. That's right, we have Monster. Now, we all know and love, you probably drunk a Monster one time or another. This is a beverage drink, okay? But Monster Beverage Corporation is an American beverage company that manufactures energy drinks, including Monster Energy, Relentless, and Burn. The company was originally founded as Hanson in 1935, Southern California, originally selling juice products, right? And also fruit. That's something they failed to mention in there. But now they're selling energy drinks, right? The Coca-Cola company owns them, of course, because we know Coca-Cola is a conglomerate. They own many, many companies back in 1935. So let's get into a little bit more information about Monster, because in addition, a Monster brand in the Monster Corporation, it has risen from surprisingly extreme beginnings, like when it first started off as the regular Hanson company that was selling juice. Because the name Monster Energy, that falls kind of under the Hanson Natural Corporation, that started in 1930 selling fresh fruit and juice, eventually expanded to selling iced tea and soda. So it's been going through constant transformation. So in a radical departure from its previous products, in 2002, it launched Monster. You know, the meanest energy drink on the planet. I used to drink Monsters, and when someone said, "Have you read the ingredients?" I stopped drinking Monsters. As a matter of fact, I don't even drink energy drink. If I really need caffeine, if I really need some energy, I just drink plain old nasty coffee, right? Maybe a little bit of sweetener, but black coffee, no sugar, no cream, and every now and again, I may get a mocha. I just may get a mocha. But we understand that Monster drinks, energy drinks, they're not recommended for children or people who are sensitive to caffeine, pregnant women, or women who are nursing. Okay, you don't want the baby. You're supposed to be nursing your baby, and you feed an energy drink through your breast. I'm just saying. Now, when it comes to the sales have exploded from 92 million in 2002 to more than 2 billion in 2012, because all of a sudden we got all these tired people that we just need energy drinks, and we just need coffee. Like when did young people need energy drinks? People in high school and college drinking energy drinks. But nonetheless, talking about investments, Monster was driving 90% of their sales by the time they changed their name to Monster Energy in the beginning of 2012. So it goes to show you that people absolutely love energy drinks. And it's a good way for you to get inside of it and actually invest some of that money. No volume? You can't hear me? No volume. Test, test. According to my program here, I have volume. So Soto, please let me know if you don't hear me. Maybe I'm a little low. Maybe you can turn up the volume on your side. I don't want to peak my mic. All right. So there are some other investments that are safer bets. I had a Coca-Cola and I sold it though. Well, the soda companies or Coca-Cola in general. As a matter of fact, let's just look at Coca-Cola really quickly if you don't mind. I think it's KO. I used to invest in Coca-Cola too because I used to follow Warren Buffett's portfolio. Okay, Money King says he can hear me. So let's look at Coca-Cola really quickly. Let me see here. It says as headquarters out Atlanta, Georgia. And see CEO James Quincy of 2017. And from when I had it was worth $30. I'll let you guys look at this as we're going over this stock right here. Let's look at this. You're not gonna switch? Okay. Let's look at this together. All right, right now it's worth $54 and a quarter. Let's look at the 5-year return. And as you can tell, when I used to invest in it, it was even lower than this. I would have made some money. When I bought Coca-Cola, it was at $30, right? And we understand that Coca-Cola is a conglomerate, right? Is a conglomerate. So they own other companies. Look at the subsidiaries: Minute Maid, Costa Coffee, energy brands. Like I said, Monster Energy falls under this. Let's do a deep dive inside of this, guys. Let's do a deep dive. It says, what companies are owned by Coca-Cola? Let's look at it. Diet Coke, Sprite, Fanta, Dasani Water, Smart Water, etc. Boom. So when you invest in Coca-Cola, you also invest in those other brands. You get what I'm trying to say? Essentially. But, investing could be tricky sometimes because that does not mean that Coca-Cola will perform well if Monster performs well, because the way they are separated on the market. But some people will say, well, eventually Coca-Cola will go up because it owns Monster. It just depends on how you look at it. Thank you, Esto. I appreciate that. So let's do a 5-year ROI here. So again, back in 2015, and I was investing this prior to that when it was at $30. Was it around here? Yeah, it was around, I think it was 2015. So I want to say maybe about 50 of these, 50 of the Coca-Colas, and I sold it. I think I sold mine around $40. So I made anywhere from I made about $9 per share. And I shouldn't have sold it because right now they're sitting fat and happy at $54 a share. And if you can tell, the 5-year span is trickling up and down, but it's mostly going up. Okay, it's mostly going up. So that's why we have to be very cognizant of how we invest, guys. Companies like Coca-Cola, they're going to continue to reinvent themselves. Now, I don't know if they will ever change their name, but we need to understand the way they're structuring their business. Okay, we need to understand the way they're structuring their business, because the company that they bought out was a fruit juice selling company. and they start selling energy drinks because that's where the market and consumers actually want it. A lot of people are drinking less soda. A lot of people are doing less tobacco because I had a tobacco company on here that was one of the best 20 stocks, best performing stocks over the last 20 years. Now, this is for an investor who wants to diversify their portfolio. If you are a beginner investor, you never invested a day in your life, or you only been investing for 90 days, I'm going to go ahead and tell you to buy total market index stocks and the S&P 500 index stock. Those are the two. And I'll let you know what that looks like. But different entities actually own a piece of those stocks. They have made up their own stocks. So let's see here. I think Fidelity has a high one with really, really good returns. Excuse me. I'm sorry, guys. Trying to make sure I get the right stock for you guys. Here we go. It's called Fidelity 500 Index Fund. All right. And we're going to look at this. Now, these have great returns. These have great returns. Like, you don't go wrong with the index funds. I'm just going to let you look at it as I switch my screens here again. What am I doing? What am I doing? This all over the place. All right, there we go. I'm going to let you look at this. Look at these returns. Now, this is the Fidelity one. Okay, this is the Fidelity one. Believe it or not, Vanguard has one as well as Charles Schwab. They perform, quite well. Look at the percentages here. So I'll just give you the max. Look at this. It had been on a steady growth since 2011. It was $46. Look at that. I just want to leave it up there for you guys to really see what investing is and what investing does. Because if you don't see it for yourself, then you're not going to believe me. And I want you to believe me that when you invest, this is what it looks like. Now I'm trying to look for the Charles Schwab one, but I'm having a little bit of difficulties. Let me go to Google Finance. Now, all right, let's look at this. Let's do a deep dive in this. All right, so back in 2011, this stock was $46.17. And look as I go through the years, if you can. In 2012, it was worth $50. 2013, it was worth $59. 2014, $66. 2015, $73. Let's see where we at. It went back and forth a little bit. 2017, $82. 2018, $90. Then it dropped all the way down back to 80 something. And then now we at $112. Do you see what I'm talking about? Do you see what I'm talking about? That is the power of investing, okay? That is the power of investing. So if you're not investing, at least, the total, the Fortune 500 ones, the 500 index, and also the ones I'm trying to show you. I'm really trying to stall here, guys, while I'm trying to pop this up. I'm looking for the Charles Schwab one. Just bear with me. They're showing me the common stock one, but on here you need to know the ticker. But anyway, and then the expense ratio is low. So the expense ratio is almost like the management fee of when you buy within Fidelity, right? Because right now Fidelity is commission free. So that's how much you're going to pay. Again, less than 1%. We're doing long-term investing. And that is what's important. Your money is going to make money over the course of time. All right, I'm about to show you guys. I'm gonna lose it. Going to freaking lose it. They showing the common stock one here, but it really doesn't give you the returns that I would think that you will want. Okay. But you know what? Let's look at another Fidelity stock, right? The one I was talking about is the total market index stock. And we're going to look at that one so you guys can see the returns that's on this one as well. So if you look at, this is a total market index fund, and right now it's worth $90 per share. And again, I'm looking at the expense ratio, less than 1%, way less than 1%. And then if I go to max, again, these two stocks, whether it be with Fidelity, Charles Schwab, or Vanguard, is outperforming the market. Like, it's doing a great job. Now let's go back. In 2011, it was worth $35. It was worth $35, okay? And that's 2013, $45. 2015, $59. 2018, $77, $78. And then now, 2019 is worth, 2020 is worth $91. Long-term investing is the key to success. It's the key to making money. So I'm going to let you just look at that for a second as I pop up these other stocks here. Just having a well of a time trying to find the right web page to pop up for you guys. I apologize for that. Love to be prepared, but today this is off on a whim. You just have to bear with me. See, that's what I'm. There it is. All right, we're in the money, guys. We're in the money. Popping this one over. Here's the Charles Schwab one. Is that the right one? Yeah, common stock. Did this thing trick me? I just had the S&P and 500 one, guys. But anyway, let's even look at the Charles Schwab corporation common stock one. And I'll just do the max again here. And see, it bolstered up to, was it back in 1999, $38. Even if you was investing back then, you would have still made some money. You get what I'm saying? So let me see, SWT. Here we go. Wow, that took a long time. Schwab Total Stock Market Index Fund, $56. We're going to look at the max. Look at it steadily go up over the course of time. So I'm going to go from the very beginning. Let's say, for instance, no, let's see. Let's go to 2006. $22 a share. $22 a share. A Jambo, I don't even want to talk about Tesla. I bought Tesla at 200 and sold it at 300, and I should have kept the freaking stock because it's now double that amount. So I'm really upset. But anyway, right here is at $22, and it has grown exponentially over the course of time. Look at this. It's still going up. This is a stock that you guys can buy into right now. And again, what did the expense ratio say? 0.030%. That is what I want you guys to look at. How these grow over the course of time. and the money you could be making from it. Then not last, here's another one. The one we were waiting for this long time I was trying to find is Schwab S&P 500 Index Fund. Again, the max. Look at this. Expense ratio at the bottom is 0.020. Let's go back 2000. It was $20. And you just kept your money in it, continue to buy stocks over the course of time, it would have more than doubled your money. See, a lot of times people are trying to get rich quick. And most rich people, it took them time to get that money, unless they was in entertainment. Most investors and business people, they would tell you 10 years is fast of being a millionaire. 10 years is fast of being a millionaire, right? Of doing something over and over again that's giving you returns. That is what you need to be aware of. When people are like, oh, I want to make money fast, I want to make money fast. Like, man, if you got a talent, if you can act, sing, rap, play sports, sell cocaine, I mean, whatever. I wouldn't want you to do none of that, the illegal stuff. But how else are you going to make money that fast if you're not investing? So I tell people, look out for long-term investments because that is where the money is. So when you're in your 50s and 60s, right, you're sitting fat and happy being a millionaire. And then when you become a millionaire, you think you're just going to do whatever you want. Nah, bruh. It don't work out like that. Let's look at Vanguard. Let's look at Vanguard. I invest with Vanguard. Pretty good company. This one, and here's another thing, guys. We're going to go back over the ones that already popped up so I can show you the information at the bottom. So we can go over that. So let's look at Vanguard. This is their S&P 500 ETF. I'm going to go to max. Look at this. Look at this. Let's go back to 2010. It was worth $100. So take, for instance, you got $3,000 on your tax return. $3,000 on your tax return. And you bought 3,000, no, not 3,000, let's say 300. You bought 3 of these back in 2010. You would have more than double your money. This is $100 back in 2010. It's worth $296 right now, $300, right? And all the course of that time is offering dividends. Look at this. Look how it's going throughout the years. Now, we look at the bottom. We see that it has dividends. So I'm going to go back to Fidelity 500. And it says dividends yield 1.95%. Let's go to the total market one. 1.79%. That means you can reinvest those dividends. Dividend yield 1.43% on the Charles Schwab one. That's the common stock one. Let's get that one out of there. And this is the Schwab Total Market Index Fund. And dividends yield is 1.61%. So not only is the stock appreciating, it's also giving you dividends to reinvest. And what does that help you to do? It helps you to save money in your investment account and do dollar cost averaging. So if you have a monthly investment account that every month it's investing money, them dividends that will be accounted in that will help reinvest. Now, granted, you also want to check to see if these particular entities, and I'm probably going to do a video on that later, if they are fractional share investing. Because if they're fractional share investing, they don't need to wait until you reach $56.22 to invest that money that's coming every month. That means that when you get those dividends, they go right back into that stock. It could be $3, $2, whatever. It's fractional, right? It's a huge math algorithm that says, okay, because you have $3, you want to own 0.00123 per share of that particular stock for one more. until it accumulates into one share, if that makes any sense. Look at this. So someone wanted me to look at Tesla. Oh, I know about QQQ, D General. I believe me, I still invest through Vanguard with QQQ, but somebody want me to look at Tesla real quick. We'll look at Tesla. I'm a little mad. That's okay. Look at this. Look at this. I invested with Tesla when it was $200. Where was it? $200. Where you at? Back here, right? Then it dipped. Right here, that's when I invested in Tesla. 2016, 2017, right? Yup. 2016, 2017. Then it went crazy. And then it is shot up January 7th, today. Yesterday, 3:30. Oh my God, what happened? Woo, woo. Look at that, ladies and gentlemen. So, I'm trying to go slow here. January 3rd is worth $443. And now, look at it now. Look at me now. $469. You got to be more careful. You got to be more careful. And that's the power of investing. That is the power of investing. And these are Power Shares Triple Q. Now, from my memory, these give great dividends. Let me check down here. Well, it doesn't look like it's great dividends, but I did a video on how you calculate dividends. I might do another one for 2020 so you guys can easily look at dividends. But there is a site. I'm gonna look that site up really quickly so you guys can do it for yourself, and you don't even have to do the conversion. Let me just make sure the right site. Here we go. I'm gonna look up QQQ. I think I'm in the right site. All right. The name of the site is called Market Watch. I love this site. I love this site to compute my dividends, okay? To compute my dividends. So let's focus on the stock. There's a lot of things going on this website, but that's fine. Now, you come down to the left side over here. And the main thing you're looking at is the dividends and money. So you got the dividend yield at 0.73%. And then you actually have the money, what that is in dollars. So that means that how many stock you own here, right? How many you own, how many shares of the Power Shares that you own every 3 to 4 months. Every 3 to 4 months, whenever they give out dividends, they're going to give you 46 cents. Now, and I used to have some really high dividend stocks. Now, Tesla, I believe they don't give out dividends yet, but I believe Apple does. So the last time they gave dividends out was December 23rd. So let's look up a stock like Apple. Let's look up Apple. Oh, yeah, baby. So Apple per share gives out 77 cents per share. 77 cents per share. Now let's look at a Vanguard. Okay. Let's go with VOO. And this is the Vanguard S&P 500 one. Okay. Look at this. Look at this. $1.43. $1.43. That's good money, ladies and gentlemen. That is good money because you're getting the appreciation from that share, right? As long as you stay in the stock market, most of these stocks are going to appreciate in value. Then you get those dividends. You say, how are people living off their dividends? Because they invest for 10 and 20 and 30 years, and then they got so many dividends coming in. It equates to $1,000 a month. It equates to $1,500 a month. It equates to $2,000 a month. Okay, so that is how they're doing it. Uber Technologies. Now, Uber is not paying any dividends because it's still trying to make way. Now, if you look at the shares outstanding, it's 1.7 billion. The market cap is 53 billion. And Uber is still growing. We can look at this one up here, right? Where is their date? Year to date. Here we go. We will go. Let's go 3 years. So starting off from the right to the left, Uber. I mean, where are we at now? That's 2020. Are they going backwards? What is this? This is crazy, ladies and gentlemen. All right, this is better. We can follow this timeline a little bit better. All right. When Uber first started off, let's look at the $41, but Uber has been declining. Uber has been declining, but I don't think Uber is going anywhere. I don't think Uber is going anywhere, but it's definitely not making you any money. Okay? It's not making you any money at all. Now, when I'm talking about making you money, I'm mostly talking about that it's not appreciating in value. The only way you lose money is when you buy a share of a stock and you sell it at a lower price than what you bought it at. That's the only way. That's the only way. As long as you stay in the market, your stock may lose value. That doesn't mean that it will that you lose money. You only lose money when you sell it. Last but not least, ladies and gentlemen, is the notorious Vanguard Total Market Index Fund. Yep. Vanguard Total Market Index Fund. One of my favorites. Look at those dividend yields, 1.67%. Of course, the expense ratio is nowhere near 1%, which I absolutely love. And here's the thing. All these index funds I've been showing you, the expense ratios, as I said before, is like a management fee. And guess what? It's even less than 0.5%. All right. Let's look at the chart here. Let's max it out. Look at this again. See, I love to see green. And this is how you do analytics. This is how you're researching. This is how you're looking at the metrics. This is statistics all the way go, baby. All the way go. We are killing the nanny today. Yes, we are. And see, I'm going to tell you, back here in 2000, it was worth $32. But let's do something more recent. Let's go from 2010, right? 2010, this stock was worth $26. So if you double it, $46. If you double it again, then it's $80. You would have had quadrupled your money almost if you would have invested in 2010. So I'm telling you, invest your money today. Don't wait another day and don't invest. Take that tax return. Take a quarter of that tax return. You know what I'm saying? So if you got, $4,000, at least invest $1,000. Take another $1,000 to pay off your debt. Now I'm gonna give you one more stock by honorary. Here we go. The SPDR S&P 500. These are pretty good as well. And there we go. What are we doing here? What are we doing? All right. This is a little pricey. Let's look at the returns though. Again, I tell you, man, listen. Dividends yield 1.74%. And of course, I can type this in here. We can go back here and do some research. What are the dividends looking like? We love them dividends. I love those dividends. Okay. Those dividends are $1.38. And some of you like, oh man, that's so low. Again, it's the appreciation of the value of stock, plus they're paying you more money. It's the appreciation. So if you sold it and it grew, right? Let's go back here. Let's say, for instance, you bought it in 2010, right? It was worth $119 in 2010. Then if you say, you know what? I need to go buy a house. I need to go buy a car. You shouldn't. You should buy used, and you shouldn't use your investments unless you absolutely had to. But back in 2010, you bought it at 119. It doubled. It tripled, bro. Listen, it tripled at $322, and plus it's giving you dividends on top of the appreciation. Right? If I go back here and I look at what was the Vanguard one I had up here? Did I close that one out? I think I did. Give me 1 second. 1 second. So I was looking at VOO, right? I think I typed in the VOO one. I'm looking for the Vanguard Total Market Index Fund. What we got? Yeah, I think I had it up here. Let's get rid of this one. Let's bring Vanguard back over. All right, there we go. So let's take that VOO. Let's just type in Vanguard. I'm going to show you all the Vanguard stocks up here. Look at all these Vanguard stocks. They have plenty. But we're going to go with VOO. We didn't do Fidelity either, did we? What's the ticker on Fidelity? FXAIX. FXAIX. So Fidelity Index Fund, every 3 or 4 months. Look at the yield, 1.95%. And this particular one, for some reason, I give you the dollar amount. Anyway. All right. So I spent enough time going through just a brief overview and review on how you, this is to do a little bit of research on stocks. Market Watch is a great one to see the dividends and see some other information that I used to look at over the course of time. I'm going to read your notes and I got to go cook dinner. All right. Let's see here. See, Money King says he bought Coca-Cola when it was $42. So now it's 56. Jambo, so he bought Tesla like me at 200, but he still has his Tesla, and now Tesla is $469 a stock. Way to stay in there, Jambo. D General, we talked about the Nasdaq Triple Q. We looked at Uber. Vanguard Total Stock Market Index Fund tracks what exactly? It tracks the total market. It tracks the total market. Okay. So that, I mean, it is exactly, this is exactly what it says. Anybody have any questions before I get off here? I'm gonna read the rest of your notes. I'm sorry. S.O. Jackson, 20% of your pay and watch the money grow. Indeed. Indeed. All the index funds have one main thing in common: diversification as well as low expenses. Esto, you on it, brother. You on it. Oh, you know what? D General, I'm so sorry. You're asking what market does it track? Like you said what it tracked exactly. Okay. So I typed it up because we know that it I'll just read it. The Vanguard Total Stock Market Index seeks to track the investment results of approximately 100% of the investable U.S. stock market. Its companies, which represent a cross section of market capitalization, primarily trade on the New York Stock Exchange and the Nasdaq. So, to your point, Vanguard Total Stock Market Index Fund tracks stocks on the Nasdaq and also the New York Stock Exchange, and it tries to track 100% of all the stocks. So essentially, if you invest in Vanguard Total Stock and Market Index or Fidelity or Charles Schwab, essentially, in theory, you are investing in the entire stock market. And again, we look at the returns, right? I'm gonna pop it back up. I'm gonna pop any one of these back up. I'm gonna look at Fidelity real quick. This is a total market index, right? Look at this. Up, 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 up. You know what? You couldn't see that, could you? I'm up here saying up, up, up. Oh man. I'm gonna show you real quick. My bad. Now, as you can see it, up, 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 up. Okay? Boom. All right, guys. I'm about to get out of here. I thank you guys for tuning in again. In the beginning of this video, if you tuned in late, we talked about the some of the best performing stocks over the past 20 years. And then for the novice investors, the beginning investors who really don't know that much about investing, I showed you some safe investments like the Fidelity S&P 500 index, the Fidelity Total Market Index, the Charles Schwab S&P 500 index, the Charles Schwab Total Market Index, and then Vanguard Total Market Index and Vanguard S&P 500 Market ETF. All right. So this is Financial Literacy 101. Thank you guys for chiming in. Hopefully you guys learned some information. And please take that tax return and I would say at least invest a quarter of it. Okay? Take the other money and get out of debt. All right, man. You guys and girls have a great evening and thank you.